You're listening to the Options Insider Radio Network. For more quality options programs, visit www.theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app, available in iTunes and on Google Play. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com.
Thank you all for getting up bright and early again this morning. Thank you everybody for coming out last night and having a good time with us out here on the property. Looking forward again to this evening. We're going to get everybody into Austin, get you downtown, and enjoy a little bit of the music in a different way down on 6th Street. Want to kick things off this morning. Those of you who were here last year know that we started off with Andy as well, and he gave a great kind of state of the state. One of the things about TABB Group, and for those of you who don't know all of my background, I spent some time working with Larry Tabb at the TABB Group a few years prior to coming to BATS. They have such a wealth of in-depth data that they're able to gather, and part of the fun job that Andy has, that I was able to do a little bit as well with Larry, is looking at all that data, analyzing that data, and telling a great story about where things are headed. So hopefully we'll get some deep insight into where volumes are at, where volumes are going, some of the structural changes in the industry, and folks' perspectives on that. Please welcome my friend, Andy Nybo from the TABB Group.
I know, it's like 2 minutes. Exactly. Good morning, everyone. Thank you, JJ, for having me here. I appreciate it. Thank you all for showing up this morning bright and early. As JJ mentioned, I'm going to be talking a little bit about kind of current trends, current state of the options industry in terms of volume, trading, where the growth is coming from, where it's not coming from. But first of all, I'd like to thank BATS and JJ and his team for putting on a tremendous conference. What a great venue, over-the-top entertainment. I know there's something really special planned for tonight, so that's fantastic. Also, the OIC for doing this event, and Lisa Moreno as well for setting up all the logistics for this. So this morning, I'm going to go through a few things. Talk a little bit about volume, what we saw in the first quarter this year, what we expect going forward, where we're going to see growth from, why the volume's going up, the sectors where volume is growing. A little bit about investor demand, how the market is evolving in terms of where the order flow is coming from, some of the trends in that space. Why are investors coming to the U.S.? Why are they using options in their strategies? Talk a little bit about the challenges we face as an industry, complexity, market structure changes, dependence on technology, all those things that are impacting our business and everybody's day-to-day responsibilities in the industry, the regulatory and legislative challenges, tax challenges we face as an industry, and then kind of take a step back and say, okay, well, this is where it looks like it's going. I spend about 90% of my time looking at options and market structure and volume, so I get pretty deep in the weeds. A lot of this data are from public sources, but we kind of massage them and do a little bit of analysis on them. So I'll kind of jump right in there. So, first quarter's been pretty good. We're up on an average daily volume basis, almost 8%. I know April was a little bit off that pace. I think about 17.6 million contracts per day now for the year. That comes, from the, again, these are quarter-over-quarter stats. Volume was very strong in January, a little bit elevated vol, emerging market crisis, some of the issues around the QE 2 or 3 or whatever it is now ending, a lot of chatter around that. The markets took a little bit of a dive in January, but all in all, volume's been pretty healthy in the first quarter. So it's things are a little bit good. People are a little bit excited about what's going on. Investors are back in, retail back in force. We put out a report in January looking at retail trading of options. And one of the findings was, and I have some data on this a little bit later, retail's back. They've been becoming a bigger and bigger part of our industry, a bigger and bigger part of the marketplace, which bodes well for the market makers and other participants out there. Rising liquidity, rising markets, more retail accounts coming in. Everything's rosy. First quarter, I talked to a handful of the larger firms, and trading was healthy in the equity markets, and surprise, surprise, options, futures even were up as well. So retail is actively engaged. We have a new book out that some of you may have heard of, Thou Who Shall Not Be Named wrote. I don't want to give them any more publicity, but things like that, cracks in market confidence, that can have a big impact on retail, and unfortunately it ripples through our industry as well as equities and other marketplaces. Looking at kind of aggregated trading volume, a few more trading days in the first quarter of 2014, we were up 10% on a total volume basis. That's a pretty good start because the first quarter traditionally is a strong quarter. Things driving it, this rising volatility. We're all the way up to 13 or 14 on some days. It's crazy. The 10-year average is somewhere around 20 in the VIX. So, we're in this environment where we have relatively depressed levels of volatility, yet trading's coming back. So I think that's a good indication that the markets are getting a little bit more healthy and demand's rising. Equity volumes, they're recovering. We're starting to see more trading in underlying equities. On a notional traded basis, we've been pretty strong. On a average daily share basis, it's been kind of weak over the past several years. But when you have stocks like Apple and Google and Priceline that are trading near, $1,000 a share, or $700 a share, that kind of tends to depress the share count. I think we're going to see quite a few share splits in the coming months, given what happened to Apple recently when they announced their split and their earnings a couple weeks ago. So I think that is all a positive trend to underlying equity markets as well as the options markets. Apple's a pretty popular retail contract, and when you start getting those share prices down, it means more and more trading in those contracts. I'm going to also be talking a little about the index and ETF volumes that we're seeing. Huge growth in those products over the past couple of years. So that's a good trend. The single stock volume has been strong but declining. The weekly phenomena, have some data on that in this presentation. Huge growth there. And then, as I mentioned before, the retail investor is back. So looking at the most actively traded symbols, one thing that jumps out pretty quickly here is 7 of the top 10 most active names are ETF or index products. That's pretty striking. And if you look, they're also the measures that are seeing quite a bit of growth. The first quarter, all this volatility, a little bit of volatility, global angst in the equity market valuations. You saw a lot of hedging activity coming in, both domestically and internationally. The NASDAQ ETF was up 72% in terms of year-over-year first quarter volume. SPX, SPY also showing strong growth. Volatility products, huge growth in those instruments. 2 of the most active options on the VIX and the VXX in aggregate grew about 50% year over year. Compound annual growth rate since 2007. So there's a lot of interest in ETFs, a lot of interest in broad market strategies for both exposure as well as hedging activity. Looking at kind of where the growth has come since 2006, equity options, single stock options are up about 6% compound annual growth rate. But if you look down the chart there on the right side, ETF volume up 23% year on year for the past 6-7 years. So that's some pretty strong growth. Falling correlation is starting to impact that. Index volume, again, 11% growth rates over the past 7 years. First quarter over first quarter up 16%. So there's a lot of interest in the index products. Deep liquidity in these projects, huge volumes as shown on the other slide. prior to this, and that kind of, the old adage, liquidity begets liquidity, is alive and well in this market. Again, ETF volume, rising equity, underlying equity volume, all good for the options markets. Talking a little bit about particular sectors and particular instruments out there. Anytime there's a volatility event, whether it's a U.S. event, a Japanese event, like the tsunami a few years ago, the financial crisis in 2008, the volume in the underlying ETF spikes dramatically. I think that with the rising liquidity in options over the past 5 or 6 years, I think if we had another, God forbid, financial crisis, you'd see a huge, huge jump in those options around the financial sector. So even though they jumped up to about 10 million a month in 2008, who knows where they would be if we had a huge dislocation. The EEM ETF, which is Emerging Markets ETF, one of the things that we heard when TABB recently worked with the OIC on a European options study, how much demand was coming out of Europe for U.S.-listed options markets. And we did, I believe, 31 interviews with U.S. sell-side and European investors during the February-March period. And the one thing that came out consistently in the conversations was the level of interest in trading the EEM ETF option when emerging markets were going down and up on a daily basis. And it was, this huge volume increase. And the European investors absolutely love U.S. markets. Transparency, liquidity. They love to be able to get into an instrument really quickly and efficiently, but more importantly, they love to get out. And there's nothing like U.S. listed options markets for that liquidity. I mentioned another kind of finding in that study as well, based on our interviews, was the interest in volatility products. It's not just the U.S. European investors are enchanted with this whole idea of being able to trade and vol in a listed product in huge notional and huge size. With a lot of the time trading day overlap with what they're doing. I mentioned before the kind of the growth in those options in those sectors. Anything volatility is hot, obviously, but in Europe, it's these guys are just fascinated. It used to be an OTC marketplace, trading a lot of OTC instruments to get their vol exposure. Now they're looking at the U.S. and going, wow, I can get this, right on the screen. I can look at the size. I can get this tight spread. So they're very interested, and we'll see a lot of growth, I believe, from that segment as well. Chat a little bit about this weekly phenomena. The first quarter of this year, we saw huge growth, 60% year-over-year growth in weekly options. Counts for about 24% of volume on any given day or during the month. Part of this huge growth, this huge expansion of the weekly interest has been the consecutive weekly expirations now that are available, 5-week expirations, as well as the number of names in the program, in the weekly program. So all of those facets, the quick trading that occurs in those weeks, the volume tends to get very high, and particularly towards the end of the week. So we've seen a lot of growth in this area. And if you just look at kind of some of the numbers in the first 3 months of this year versus last year versus 2012, just amazing how many contracts. Almost 250 million contracts traded in the weekly program in the first quarter. That's out of about 1 billion contracts. So it's a huge sector. Any kind of spikes involve any kind of activity, any earnings events, capital market events. The go-to product set now for some of the bigger firms, hedge funds, even asset managers now is the weekly options. So I expect to see continued growth in that segment. 30% of total volume is easily attainable, if not more, depending on what the exchanges do and what the SEC does in terms of the rules around that set. Again, it's the index names, it's the ETFs. There's a handful of the retail names in there, the Apples, the Facebooks, the Teslas, the kind of the big names. The Bank of America, I would expect these numbers to look a lot different in the next couple of months, given the recent announcement out of them. But these are, fast trading. These are trend trading instruments, very popular with retail accounts, as well as those looking to quickly hedge positions around earning events and target their trading activity. The other thing was the expansion to those 5 weekly expirations and more names in the program. So what we saw is this huge broadening out of activity in the weeklies, which I think is a pretty healthy trend. Lots of concentration in those top 10 names, of course. Lots of liquidity in those names. But if you look on the right side of this chart, the 51 to 398 or whatever number of names in the program had accounted for about 20% of volume in the first quarter versus, just 12%. So, they become more of a trading product across different instruments, more instruments, as opposed to just getting in there and trading them in and out all day during the week. So it's transitioning to a much more adaptable instrument that firms are using in their portfolios. I don't know who this guy is. He's always in our presentation, so. Don't worry, took the picture. It's not Larry, because Larry doesn't have that much hair. So looking at kind of why the U.S., why are options markets growing so much? And this chart, we created this chart for use in that European study. And since 2010, U.S. markets are up 67% on an index basis. And you look at the U.K. and Europe, and they're just simply 27%. You can't even live on that. 20% for Europe, and they're mired in tax policy and FTTs and things like that I'll talk a little bit about. But so a lot of investor interest in the U.S. Over the past couple of years, there's been a lot of foreign flow into the U.S. markets. Our study we released in March showed about 9% of total U.S. activity comes from European investors. No surprise when you look at a chart like this. It was the emerging market, effectively, since we came out of the economic crisis a little bit faster than most other economies. We did notice in our conversations that macro funds were pulling back a little bit from U.S. markets, and they were starting to look inward in Europe and other areas of the world. So volume and the amount of order flow coming from those large hedge funds from outside the U.S. is starting to decline a little bit, but we're still hearing stories that the volume's coming, and believe me, investors are very interested in our markets. We're a quote-driven market, about 47%, I guess, in the first quarter. 46% was market-making volume. On the other side of that, we had about 30% of activity we estimate was institutional flow, and that bottom number, which is pretty interesting, about 24.3% of total flow in the first quarter was from retail accounts, which is a huge chunk of the market. Drives a lot of activity, drives a lot of business for the retail guys and for the market-making community and consolidation community. And we've seen pretty healthy growth. When we did our study in January, we talked to a number of market makers, the consolidators, retail guys, and the theme was really all about, we can't believe how much demand there is coming out of retail. It just continues to grow and expand. And if you look at retail accounts, what they have available at their fingertips through their front ends, it rivals what some of the biggest and best hedge funds have on their desktop. The amount of analysis and tools that they can use to trade is just incredible for a retail investor. Most retail shops have their web-based front end, and then they have the power front end that provides, direct market access and transparency and just incredible amounts of tools and sophisticated trading capabilities. The retail brokers are also spending, as well as OIC, spend a lot of time and effort educating investors. Mom and pop want to have a better understanding before they do something, and all that education, all the targeted webinars and information and documentation on why you should not, more importantly, be trading options is having an impact. One of the things that we noted in our January study was the rising sophistication of the retail investor. They're doing complex orders. They're doing spread trading. You can do it. It's really easy to do a spread trade on the web on some of these powerful front ends, but retail guys want multiple multi-legged capabilities as well. So they're mimicking kind of the sophistication of institutional investors moving on to more powerful ways to trade options. There's also a growing community of kind of ex-Wall Street guys and ex-Chicago guys that are starting up, their own little prop trading firms, or running their own account and running their own money. And they're used to having these tools. So they want to get these tools that they can really be aggressive in trading options and kind of adding a lot of flow. And those aggressive traders are where a lot of the flow is coming from, because they're doing multi-legged transactions. So they're trading, multiple levels of contracts, and that's adding to the volumes. The other thing that was pretty striking is the commission rates that these guys are paying. There's boutique options trading for brokers on the web that you can trade for free. Obviously, there's economic incentive in their flow, which they route to the market. But for the retail investor, he can get his trade done, as many contracts effectively that he wants to do. He's getting price improvement most of the time if he's putting in a market order. So it's really the retail investor is living large now. They're getting great execution. They're getting great access to the market, and that's why the market is the retail demand is growing, and has grown a lot. I had mentioned Europe before. There's a lot of flow that comes out of Europe, almost 10% we estimated in the first quarter of this year. Some of that comes from other areas as well, that's routed through London or Switzerland, from other locations around the world. But there's a high correlation between where those equity assets are held and where that options flow comes from. So no surprise, UK, lots of investor management firms there, hedge funds, and asset managers domiciled there. But Luxembourg, Switzerland, the Netherlands, a lot of where the private wealth community is located. The one thing we identified in our 2014 study, European study, was an emerging demand from private wealth guys, right? So the way we do our research is we call. We call people, we get them on the phone for 30, 45 minutes, we pick their brain, find out what's going on. It's all anonymous, they're pretty free with what they say. So I called a private wealth guy at 9:25 in the morning, East Coast time. He almost ripped my head off because the market was opening in 5 minutes. Meanwhile, it's 2:30 in France. It was a French guy. He was just beside himself that I would dare call him at 9:25 in the morning, right before the market opened. So that was kind of a wake-up call. They have execution experts that focus solely on U.S. markets. And this guy was a derivatives guy. He traded options for all his investment advisors through that one desk. And it wasn't just his firm. There's other firms that are doing that. The other thing that came up a number of times was retail brokers in Europe are looking at U.S. markets. It's easy to access. They can give lots of data to their clients. And their clients are exposed to CNBC and all the different things that we see on a daily basis. They see, the fast money segment talking about options. So they want access to U.S. markets as well. So there's a handful of brokers, and I would guess more, given I only talked to 3 or 4 for the study, that are rolling out products, rolling out access to U.S. listed options markets. Not a lot of flow now. But over time, that will be a growing area of demand, I believe, for U.S. listed options. They trade a lot of warrants and structured products in Europe now, so they're familiar with kind of how those products work. But when they get a look at a screen and they can see depth of book or the amount of price at various levels and the tight spreads, they're very interested in getting access to U.S. markets. The retail brokers in Europe love it because they're charging $5-6 a contract to access U.S. markets. So that's kind of a current situation, because I believe competition will start to erode those margins, and expect that the individuals will figure it out pretty darn quick. So looking at some of the challenges we face as an industry. This is one of our biggest challenges. 12 markets, 12 exchanges, all using different trading protocols, all having different kind of trading models, trading rules, all issuing new rule sets just about every month. Hundreds of pages for a routing firm, for a broker, for a consolidator to kind of manage all these rule changes, fee changes. So it's challenging to be, kind of that middleman in the marketplace, the market makers or the sell-side brokers. It costs a lot to maintain the connections. If you're a consolidator, you have 12 connections. Big consolidation firms spend upwards of $25–30 million a year to support their technology. I don't know how many times I'll mention technology in these next couple of slides, but that is one of the biggest challenges. It's also one of the biggest reasons why our markets are so liquid, so dynamic, and there's so much volume. Innovation breeds new product types, faster trading techniques, better types of orders, in a good way, not in a thou who shall not be named way. It is, lots of activity across different exchanges. Fees are declining. It's tough to be an exchange now. There's a lot going on, and you have to come out with a new mousetrap. This slide just kind of shows you that all these rule changes, this is what happens. It's, all this competition, it's hyper-competitive access to flow. It's how can I get that market maker to route flow to my exchange or trade on my exchange. There's 12 exchanges now. We're going to see more. It's relatively cheap to start an exchange. The paperwork, the compliance, all that is really not that much to manage. It's the ongoing costs of competition and technology and what have you to support your customers, support the technology you need. I mentioned before the trading of weeklies. We've also had penny increments introduced over the past 9 years or so. The market structure, concentration of liquidity, front month, front week, I guess it would be, trading activity. More than 70% of all trading is in the top 100 names. So there's huge volumes, huge flow in those names. And, those are the ones that trade the most, have the most price changes, have the most market data, have the most interest from investors. So, with all this concentration of liquidity in those top 100 names, you better be really good if you're going to trade those names as a market maker or as an exchange to provide access to those names to support the technology needs. And again, there's that technology words. You have the market making community that there's very few guys that are one or two guys that are trading in the pit anymore. It's all automated. A lot of it's automated. They still do a little bit of point-and-click trading, still take some shows, and still trade over the phone a little bit. But unless you really are a very small one-man shop or two-man shop, you really depend on technology to operate your book and to trade actively across multiple exchanges. And that's where the problem is. When that technology breaks at a market maker, at a dealer, at an exchange, the system breaks. And, this week we had another instance. Last year at the OIC we had another technology challenge. Technology breaks sometimes. It's going to happen. And what we need to do as an industry is come up with the right tools, with the right reactions, with the right protocols, so that when something breaks, okay, this is what we need to do. Consistent rules, erroneous trade rules, cancel rules. It needs to be, documented and put across all instances of trades. Having different schema, having different rules by different exchanges is, it just adds that complexity in the regulatory oversight side. And people don't know what's happening with their book. If there's a trade break, they need to know now so they can get rid of that hedge or put that hedge on. So that's a challenge as an industry. We need to kind of make sure that protocols are followed and are consistent across all kinds of technology breaks. I'm not going to dig too deeply into the whole regulatory and legislative and tax area. I don't have personal feelings about all this stuff, and I don't want to get too deep into it. But as an industry, we need to keep an eye on what goes on in Washington, what goes on, in Brussels, what goes on across the world from a regulatory perspective. Wall Street is huge. Fleet Street is huge. There's all this money being made, right? It's a very attractive target for the politicians, for regulators, not so much regulators, but for the tax authorities around the world. They look at this as an easy way to get money. You know, the Robin Hood tax, financial transaction tax, really, you know, it's being applied in Europe with some mixed results. You look at Italy. They have a financial transaction tax right now. Their volumes have fallen through the floor. So I'm sure they're kind of taking a step back and going, wow, what's going on here? The UK was fighting against the Euro FTT, the European FTT. They lost that battle, I believe, yesterday or last night. You know, FTTs have unintended consequences. Financial transaction tax can have bad consequences. Absolutely will impact liquidity. So it's something that we need to kind of keep an eye on. There's various local bills that are looking at ways to raise revenue from all this trading activity where everybody makes $1 million and you know, drives nice cars everywhere. FATCA. International tax regulations can impact demand. You know, effectively, FATCA is a know your customer rule across border. One of the things that came up in our interviews for the European study was that a lot of the well-to-do, wealthy individuals, when asked to provide more information about who they were and where they got their money and where they had their money, simply say, no, well, I don't want to trade that market. So if you're trading U.S. securities in Europe, now you're subject to IRS withholding, the arm of the IRS withholding police. So that tends to dissuade demand. And then the kind of the efforts to reform our tax code, the Camp proposal, which was talked about yesterday, you know, although he is retiring, it's still alive and well. When Washington looks at the potential revenue that can be raised through these tax initiatives and these proposals, it's very attractive for them. They look at it and it's, you know, it's Wall Street, so, you know, mom and pop will support that. So you can't relax your guard just because it disappears. I believe Jim Toes yesterday on the panel said that, you know, in Wall Street in Chicago, you know, yesterday was yesterday, but in Washington it's 3 years ago. They have this long procedure and they're constantly thinking about it. And it takes a long time for these things to wind their way through the legislative process. Things like Basel III. Dodd-Frank, the European Market Infrastructure Regulation, remember, you know, not directly impacting trading of U.S.-listed options, but behind the scenes, on the capital side, on the balance sheet side, they're restricting, they're requiring banks to hold more capital and charges against what they do. The result is banks look at this and go, okay, well, what's in it for me? What's the best area I want to be in? So they're going to start pulling back a little bit on capital provision to investors and look at their credit counterparties. So that can impact the amount of liquidity, the amount of volume that we see in options markets. One of the things we noted last year in our buy-side study was hedge funds were telling me, you know what, I can't even get a trade done anymore. My brokers are telling me to go elsewhere. You know, so the brokers are the bigger sell-side firms are culling their client lists. So those small and medium-sized hedge funds are kind of that need a little bit of margin, need some capital, or kind of throwing up their hands and say, how can I do this? If they can't get a trade-off in the listed market on the screens, they're going to start using other products. Maybe they'll go to equities and you know, go short, go long as an alternative. But you know, that is something that I think will continue to build the pressure on bank balance sheets. And of course, that guy on the left, shall not be named, you know, he started another firestorm of attention on those dreaded HFT. And you know, nobody can define HFT. What is it? It's three initials. It's you know, kind of HFT. It's high frequency trading. But what is high frequency trading? I mean, you know, we're going faster and faster as an industry. Our trading activity is faster and faster. You know, if you're a market maker and you're not fast, you're not going to be around for a while, right? You got to manage your risk, and it's more about managing risk exposure than getting into the market or front running or whatever that guy said about, you know, the markets being rigged. So everybody's jumping on the bandwagon. You have the New York State Attorney General. You got Holder licking his chops there, saying, "How can I get these guys in another way?" City of Providence is, you know, thrown up the mantle here and says we're going after all those HFT profits that Wall Street took from us over the past 20 years. And then, you know, ultimately the SEC will be forced to act. They'll do a review. It's not just going to be on equities. It's going to be across all markets. It ultimately leaks over. So, get ready, a whole nother layer of oversight, a whole nother layer of inquiry. As an industry, that costs a lot of money to deal with these inquiries, but, at the end of the day, you got to educate. We have to tell them, this is what the consequences of some of these rules can have on our industry. So kind of where does this all leave us? Volumes picked up. I'm relatively optimistic going out through the next 9 months of the year and going forward. There's a lot of organic demand. There's a lot of growth opportunity from the investment management, the asset manager, the private wealth industry to use options in their strategies. Ukraine, it's amazing. 5 years ago, if there was the prospects of another regional war, I think the market would have had a little bit more reaction. I was talking to someone about it last night. It's amazing. The vol is under 15, and nobody seems to be concerned about a potential, huge altercation on the other side of the world. You got the Fed Reserve. You got a new chairman. They just announced another $10 billion reduction in QE2 yesterday. So their shift as they go from a less accommodative monetary policy, volatility will continue to pick up. And we're seeing a little bit of weakness in the economy. The results of some of these firms haven't been selling the past couple of weeks. So I just think vol is going to start picking up. Trading volume is going to remain strong. Foreign demand, again, I think Europe is a big part of our industry in terms of demand. If you look at trading on Easter Monday, the Monday following Easter here in the U.S., volume's down about 10% every Easter Monday for the past 2 or 3 years. So when the foreign investors are on vacation, guess what? Our volumes go down. So there's this huge pool of demand that will continue to support our market from foreign sources. The one thing about the retail growth I mentioned before, we're at 24% of total volume. If there's any type of erosion in market confidence, if there's another flash crash, if there's another Facebook fiasco, things like that scare retail investors. They're going to pull back. They're going to pull back from equities, and they're going to pull back, obviously, from the related options markets. If we get these huge spikes involved, that's not good for the retail guys. So that's an area to watch. But given what we're hearing, given what the retail guys are doing, I think it's a pretty sustained source of demand going forward. Market complexity. Yeah, we got 12 exchanges. We'll have 13, 14 in another year. Yeah, we have to rely on technology, and that's just the way it is. Technology breaks. We have to be ready for that. Don't need a backup system for every system and a third layer for every other system. But you just need to have an action plan in place when something does break. You don't need to invest in bulletproof cars for everybody, just those who need it. Again, the things that we got to watch out for is Washington doing something, global regulators doing something that kills our industry. The Camp proposal, perfect example, that was may have been grounded in certain tax policy, but ultimately it could have decimated our industry. So we need to be kind of aware of that and keep our eyes on what they're doing and what local guys are doing and local tax authorities are doing as well. And lastly, this whole idea of that was raised in the book, that's going to impact us from compliance, from oversight, from more intrusive examinations from the multitude of authorities that follow our industry. So compliance costs continue to go up. So that's my prepared remarks. I'd be happy to take a couple questions. I think we do have a couple minutes for questions. If anybody has any? None? That's it? All right. Great. Thank you all very much. Appreciate it.
Thank you, Andy. So, mention here Dodd-Frank. Yesterday, we heard a phrase as well mentioned during the afternoon for those of you that were here. Not one that we've heard a whole lot here in some of our options get-togethers and different events. That of the systemically important financial market utilities, the SIFMUs. It was touched on briefly yesterday. The next gentleman up is going to be able to address much more in depth, not only that, but really what it means for all of us when it comes to the OCC and some of the changes that we're seeing and experiencing as some of that starts to come and affect us all directly at the bottom of the line and in the way that we look at risk and think about risk. So please welcome up Executive Chairman of the OCC, Craig Donahue. Thank you very much. Thank you.
Hi, good morning, and thank you very much for inviting me to be with you today. I want to thank our hosts, BATS, this morning, as well as our other exchange partners, to talk to you about the changes that are occurring at OCC and in the post-trade landscape more generally. And then certainly I'd like to take an opportunity to address the recent announcements with respect to our fee changes and refund changes for 2014. As you've just heard, the options industry continues to experience tremendous growth with a 10-year compounded annual growth rate of 13%, compared to just 11% for the futures industry and 3% for the cash equities markets. I personally believe that growth is going to continue as we continue to see advancements in new products and clearing services at OCC, as well as increased utilization of our markets by institutional users. Sustained growth in an industry like ours is a consequence of many things. Our exchange partners bring buyers and sellers together by providing competitive, transparent, and deeply liquid markets. Our clearing and non-clearing members facilitate both agency and proprietary trading. Market makers provide the critical liquidity that makes our markets efficient for customers to transact. And last but not least, OCC provides financial stability by guaranteeing the performance of every transaction that occurs in all of our markets. Last year, OCC cleared more than 4 billion equity derivative contracts, and we hold approximately $100 billion in customer margin collateral, and we move approximately $3 to $5 billion a day between and among market participants. Throughout our 40-year history, our clearing fees have remained the lowest in the industry, in most cases by a very wide margin. Additionally, since 1974, OCC has refunded more than $2 billion to clearing members who primarily pass those refunds back to market users. While I recognize the concerns expressed about our recent fee changes, I think it's important to consider these temporary measures in light of the longer-term context I've just described. I'm going to come back to expenses and capital requirements and fees in just a minute, but before I do that, I'd like to provide some background for you so that you understand the regulatory environment that we are operating in at OCC. As everyone here knows, the 2008 financial crisis exposed major structural weaknesses in our financial market systems. Among many problems, one of the key problems that contributed to the crisis was the fact that the OTC derivative markets had mushroomed to about $600 trillion, or approximately 10 times world GDP in 2008. The market had clearly grown larger than the supporting infrastructure and the risk management methodologies that supported the market. For example, there was a significant backload of unconfirmed transactions in the credit default swaps market. Many counterparties failed to adequately confirm and collateralize their transactions. Valuations were highly subjective, and trading and credit extension ground to a halt as market participants worried about the performance of counterparty obligations. In contrast to the OTC markets, the listed markets and OCC functioned extremely well because people understood the value of the OCC guarantee and the distinctive features of the central counterparty clearing model. At OCC, as I know you're well aware, we operate on a daily mark-to-market, pay-as-you-go basis. We revalue positions daily and effectuate daily settlements. We only accept high-quality collateral, and we maintain stringent financial and membership requirements, including a $5.5 billion guarantee fund and assessment powers to ensure the financial stability of all transactions in our market. Given these differences in the functioning of the listed and OTC markets, I think it's not surprising that the G20 determined that clearinghouses could reduce systemic risks in OTC derivative markets. At the same time, however, policymakers also recognize that shifting OTC derivatives to central counterparties could further concentrate risks in clearinghouses, and that central counterparties themselves are perhaps too big to fail. And it's really this recognition that created the paradigm shift for how clearinghouses like OCC are now regulated. I normally don't like to read quotes when I'm speaking, but former Fed Chairman Ben Bernanke really summarized this very well in remarks he made in Georgia in 2011. He said, "What was once a landscape of numerous separate clearinghouses that operated largely independently from one another has now become dominated by fewer and larger clearinghouses supporting more integrated markets and consolidated global financial firms. Moreover, the same globally active banks participate in all of the clearinghouses, and the major clearinghouses often rely on similar sets of banks for payment services, funding, settlement, and emergency liquidity." He said, "In such a world, problems at one clearinghouse could have significant effects on others, even in the absence of explicit operational links." And he concluded, "The need for strong risk management and oversight of clearinghouses will only increase as we go forward." With the passage of the Dodd-Frank Act and similar legislation and regulation around the globe, regulation of central counterparties has been fundamentally transformed. In 2012, a group of international regulators issued principles for financial market infrastructures which set new international standards for systemically important organizations such as central securities depositories, trade repositories, and central counterparties like OCC. In July 2012, OCC was designated a systemically important financial market utility, one of only 8, by the Financial Stability Oversight Council. This expanded OCC's regulatory oversight from the SEC and the CFTC to also include the Board of Governors of the Federal Reserve System. Following on the heels of the PFMIs and the separate rulemakings by the CFTC and the Fed to implement them, the SEC has now proposed its own rules to implement these standards for OCC and other covered clearing agencies. The net result of this is that the regulatory standards for clearinghouses are similar to those in place for complex, systemically important banking institutions, and this has been a game changer for OCC. It has increased our need for additional resources, in particular in the control functions such as compliance, enterprise risk management, and internal audit, and it has enabled us to ensure that we can meet the heightened standards that now apply to us. In 2014, headcount and operating expenses at OCC have increased by 15% as we work to ensure that we can comply with the new requirements. While I'm relatively new in my tenure at OCC, I want to make one thing very clear. These additional resources are critically necessary for OCC. They support our core mission in terms of risk management, operational integrity, and internal controls. Another important aspect of the new standards relates to minimum regulatory capital. Government officials and regulators have determined that clearinghouses should maintain liquid financial resources equivalent to 6 months of operating expenses to insure against general business losses. I think it's hard to argue rationally that this requirement is unsound when one considers the central role we play in supporting our capital markets and the functioning of the broader economy. Earlier in my remarks, I mentioned that most of OCC's working capital has been refunded each year to market participants, including a $47 million refund for 2013 that will be paid by September of this year. Because of that, OCC's net working capital is approximately $25 million, or the equivalent of approximately 1.5 months of operating expenses. I think it's self-evident that a systemically important financial institution like OCC that holds nearly $100 billion in customer margin and guarantees the performance of all obligations to market participants should maintain equity capital in line with the new requirements, even if the new requirements did not exist. So let me bring you to January when I joined OCC as executive chairman. The PFMIs and the CFTC rules on liquid financial resources had already been adopted, and the Fed rules had already been proposed in early January. While the SEC's proposed rules were still in development, we were aware that it was likely they would be published very shortly, as they now have been, and that they would likely be effective in 2014. That left us with a potential shortfall of approximately $67 million and the prospect that we might not be in compliance with the requirements of the SEC, the CFTC, and the Fed. Between January and March, we worked diligently to identify various alternatives for raising equity capital. The new standards speak to shareholders' equity and retained earnings, and not debt or other contingent capital arrangements. Raising equity capital in an organization like OCC is actually challenging because we're a private company. Our shareholder exchanges do not and never have received dividends, refunds, or other distributions. As I mentioned earlier when referring to the $2 billion in refunds that users have received, it is our clearing member firms and their customers who receive pass-through refunds who have benefited from OCC's strong financial performance over the last 40 years. So given the timing limitations and the constraints on raising equity capital, our board unanimously approved the elimination of the discount, returning to the rack rate, and the suspension of refunds in 2014, sufficient for OCC to be 100% compliant with the new requirements by the end of 2014. In our announcement, we highlighted that we expect these changes to impact 2014, but we do not expect such changes to materially carry over to 2015 or subsequent years. In closing, let me just say a few things. First, we do recognize the impact that these changes have on you, and neither OCC management nor the board took this decision lightly. Second, I think we could have and should have communicated in a much better fashion with you on this topic. Nevertheless, I am here today in the spirit of doing that, and I appreciate that you've been patient in listening to me and that no one has thrown a shoe at me. Third, I want to say that we are working on a forward-looking 5-year model, a comprehensive look at what we think as we go through and emerge from the many changes that we're undergoing at OCC. You know, what do our forward-looking expenses look like? What is the growth rate of that? Where should fees be set? How can we continue to have a very strong history of success in terms of refunds to clearing members and market participants? And what is the going forward capital plan? I assure you that we will provide you with something that is both more predictable as well as more transparent for you, and which has a longer time horizon in terms of its planning. And then finally, and most importantly, I just want to unequivocally reaffirm our strong commitment at OCC to maintaining low-cost, efficient operations while we continue to provide sound risk management solutions and financial stability to market participants. In my view, the regulatory changes that are happening at OCC are very positive for OCC. I believe these changes will make us even stronger and even more resilient in order to support the continued growth of our industry. I want to thank you very much for listening this morning, and I'm happy to take any questions in the couple minutes we have.
The preceding program was a production of the Options Insider Radio Network. For more quality options programs, visit www.theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app, available in iTunes and on Google Play. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, facebook.com/theoptionsinsider, or via questions@theoptionsinsider.com.